An investment analyst, Omotola Abimbola, as we turn our attention to the banks. We're talking about the drum beats that are already sounding in the banks. And of course, very recently, we had reports from international ratings agencies with regards to the state of these banks. And the Central Bank of Nigeria says no Nigerian bank is in distress. Omotola Abimbola, an investment analyst with Afrinvest, joins me now. Omotola, good morning to you.
Good morning, Harriet.
So, give us your assessment about what all these ratings agencies have said in the last couple of days. There's been a lot of reports that have come out. Fitch very recently rated the Nigerian banks, and this has caused more than a few palpitations. But just give us your immediate reactions to these reports.
Correct. Well, the ratings that we've been saying, they've been mainly against the backdrop of the weaker asset quality of Nigerian banks. Don't forget, 2 years ago, when the decline in oil prices started, a number of the oil and gas exposure of Nigerian banks, the loans accounts were troubled. And as at then, and up to last year, total loans to the oil and gas sector was about 27% of the aggregate loan book of Nigerian banks. So most of those assets were challenged because of the lower oil price environment, which affected the operational financial performance of the companies that they lend to, and then also affected the ability of these companies to efficiently service their debts and make the final repayments. And for a number of Nigerian banks, what they've been doing to cope with this challenge is probably to write down a significant chunk of those assets, and some have opted to restructure the loans into longer tenors. And of course, this would have an impact on their liquidity, because initially, if you are planning to receive about $100 million now as interest payments for a year, but because you have to stretch the loan tenor outward, that would reduce the ability to earn interest income in the interim. And then that's also affecting their capital adequacy as well, because they have to write down a significant chunk of these assets. And that's on one hand. But because the oil price decline has been having significant impacts on the general economy, so what we've been seeing is that even loans to other sectors that are not particularly so oil, such as manufacturing and trading activities, they've been going bad as well because of the FX issues we're having in the economy over the past 1 to 1.5 years. And now the rating agency are basically trying to gauge the ability of the banks to have very solid financial performance and balance sheets to enable them to pay back their creditors. And if you truly look at the operational performance of the banks over the past 1 year, we will discover that their profitability has been declining. The quality of the assets on their balance sheets have been declining as well. And now, last month, when we had the move to a partially floated currency, what we saw was that the value of the local currency weakened, and that would have an impact on the loans that the banks have issued out, especially the foreign currency loans, because the value of those loans are going to increase. And then in a situation where the economic fundamentals is weakening, the ability of the people that they lend to actually repay back on this much higher loan book will be a lot challenged. So that's going to have an impact on the asset quality of banks as well, which is why we've seen the recent downgrade we've been seeing over the past week. And then Skybank was also a major trigger for what's been happening. Last week, the CBN opted to make key personnel changes in the bank because of the problems we were having with the asset quality, as well as compliance with prudential guidelines on liquidity and capital adequacy. So there is a scare now in the investment community that this may probably, extend to other banks as well in the industry, and we've been seeing the impacts in the financial markets as well.
But then the Central Bank of Nigeria has, very clearly stated that in spite of what is going on, no bank is actually in distress. Yes, they've got a little bit of issues, but the banks are stable. And that's what most of these international ratings agencies have also confirmed, that the banks are stable.
Correct. The banks are stable, but their profitability and financial strength have been significantly impacted by the oil price decline and the weaker economic backdrop. And we cannot take that away from what's been happening in the overall economy. as well as the financial report that these banks have been submitting. And that's essentially what's been driving the ratings downgrade. But we would allow the position of the CBN at the moment that there is no bank in distress. I mean, they've been very proactive in trying to reduce the contagion risk that Sky would have created in the industry if they hadn't stepped in at the right time to try and change the personnel that have been managing the banks to ensure that they're able to raise capital and increase their liquidity buffer.
But then how do you expect the markets to react to this? You already alluded to it. We're seeing for some particular stocks getting heavy knocks, especially for the banking stocks listed on the Nigerian Stock Exchange. What are your thoughts with regards to that? Do you expect in the coming days to continue to see investors book profit very heavily of banking stocks, especially those ones that were mentioned in the reports?
Well, to be very honest, when you look at the valuation of most of the banks now, they've already been heavily discounted. I mean, they've been sold off significantly over the past 1 year. And of course, most investors now are looking forward to the earnings seasons. And when you look at the trading pipeline between the Tier 1 and Tier 2 banks, what you would find out is that for leading Tier 1 names such as Guarantee, Zenith, Access, and also UBA to an extent, they're saying that sentiments for these stocks have been a lot more better than the Tier 2 banks and the Tier 1 bank with the highest exposure to the oil and gas sector, which is FBMH. So what we might be saying in the industry is more of a defensive positioning. You will see investors trying to sell down on Tier 2 banks that are a lot more exposed to the economic decline and who have relatively weaker quality of assets and smaller size of balance sheet to absorb the crystallizing macroeconomic and industry risk. So you see the basic positioning, which implies that a lot more investors will be moving from the Tier 2 sector or segments rather to the Tier 1 space, where earnings capability is a lot more stronger and